Hi guys, welcome back to my channel. Kelvin here. So over the past few weeks, the S&P 500 has been going down like whee! But last week, something incredible happened. The market started going back up like whee! S&P 500 went up by over 6% in 1 week. Nasdaq 9%. Even my Tesla has been on a mini bull run. So here's the big question. Has the market already bottomed out? Can we buy now and what big? I will also share how I'm investing during this period. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a dot going down a slide. Alright, let's start right now. Okay, before I talk about why the market is rallying, let's talk about why the market is going down. First, there's inflation. The inflation rate rose as high as 8.5% in March, the highest it has ever been since 40 years ago. This problem was originally caused by the pandemic, which caused businesses to shut down and drove up food and energy costs. And just when everything starts getting better, Putin be like, but wait, there's more, and decides to start a war. This caused food and energy prices to go up even more, which indirectly caused Malaysia to face chicken shortage and Singaporeans to start holding fresh chickens. Second, demands are slowing down. We can already see this happening in many places. E-commerce sales have started to slow down. People are unsubscribing to streaming services. Walmart, one of US biggest hypermarkets, just missed their earnings and is forecasting a slower growth ahead. Tech companies are laying off their employees. US housing market is slowing down. All this just means that consumer demands have started to slow down, which in turn will affect companies' earnings. Third, recession fears. So, because of prices going up and slowing demand, people are worried that a recession may happen soon. One good indicator of a recession happening is something called U-curve inversion. Whenever a U-curve inverts, a recession tends to happen within 6 to 18 months. This is the 10-year treasury minus the 2-year treasury chart. When it goes below zero, it means that the U-curve has inverted. And just very recently, the U-curve has inverted again, which means that a recession could be coming soon. Last but not least, interest rate hike. The whole market started going down in November, right after the Fed announced that they'll be raising interest rates soon. The reason they are raising interest rates is to prevent the inflation from going too high, because when interest rates go up, the cost of borrowing becomes more expensive and people will spend less, which causes inflation to fall. But here's the problem. On one hand, if the Fed raises interest rates too slow, it might not be enough to fight inflation. On the other hand, if they raise it too fast, they might shock the economy into a recession. The previous Federal Reserve Chairman, Paul Volcker, did just that. In 1979, when inflation shot up to almost 15%, he decided to raise interest rates all the way to 17% and cause a recession. Now, even though the Fed is aiming for a soft landing, meaning lowering inflation without causing a recession, Powell has said that he can't guarantee a soft landing. They had also said that they won't care what's the effect on the market. Their goal now is just to fight inflation as much as possible. Okay, now that we know why the market has been falling, let's talk about why the market started to U-turn and went back up instead. First reason, more optimistic data. Just last week, reports show that consumer spending went up and inflation has started to slow down. This is good news, right? Because now it seems that the Fed's plan of raising interest rates might be working. And if it does work, the Fed won't have to keep raising interest rates so aggressively. Quick pause, some of you may be wondering, where did Kelvin get all his stock news from? Let me intro a platform to you, Seeking Alpha. Seeking Alpha is an investment research platform where you can receive coverage for stocks, ETFs, and discover different trading ideas. For example, here's an article discussing whether we are at the market bottom yet, why Palantir could be a good buy, or why analysts are bearish about Tesla. You can also see useful company infos like financial reports, valuations, and ratings. Speaking about ratings, they have something called quant ratings, where they look at different metrics to find stocks that have the potential to do well. The basic version of Seeking Alpha is totally free. With the basic plan, you can receive investing newsletters and limited access to in-depth news and analysis. But if you decide that you want more stuff, you can sign up with my link down below and get $40 off your premium plan. With it, you will have unlimited access to premium contents, author ratings, stock dividend grades, and much more. So check out Seeking Alpha if you want to upgrade your investing knowledge today. With that being said, let's get back to the video. Second reason, there's something called relief rally. This happens when the market drops too fast and the rebound is caused by technicals. Let me show you how that happened. This is a chart of the S&P 500. If I draw a parallel line, you can see that we are in the descending channel. Every time it hits the top or bottom, the candles start going the other way. And last week, it hit the bottom, which caused the market to start turning around. Another indicator is the RSI. If the purple line reaches 30, it means that it has been oversold. If it reaches 70, it's overbought. Similarly, when it's oversold or overbought, the candles start going the other way. And that's what happened last week. Relief rallies happen all the time. In the 2007 market crash, there were a total of 10 relief rallies. Same for the dot-com bubble, where a relief rally gave almost 25% return. Or in the 1929 bear market, the biggest relief rally gave 72% return. So here's the big question, have we really bottomed out? Or is this just another relief rally? Jim Cramer believes that we will be seeing a market bottom soon. But people have found that the opposite of what he says usually comes true. So that means we won't be seeing a market bottom yet. Another analyst feels that the S&P 500 could fall a lot more. Now it's just a 19% drop. And he says that it can fall up to 45%. What do I think? I don't know, I'm not a fucker. But like everyone else, I like to speculate. My guess is that the market can go down a bit more. Here are my reasons. First, the market is still considered overvalued. If you look at the historical price to earnings or PE ratio of the S&P 500, the mean has been around 16. And even after the recent drop, the PE ratio is still quite high at 21. So I believe that the market can't continue going down until it reaches the mean. Also, fun fact, right now, we are still not in a bear market yet. A bear market happens after the S&P 500 has dropped by 20%. We have only dropped by around 19%. So, not there yet, huh? But if a bear market does happen, here's how long bear market lasts. From 1950 till now, there have been 15 bear markets. The drawdown has been anywhere from negative 19% all the way to negative 56% in the 2007 financial crisis. The average drawdown is around negative 30%, while the average number of days to drop from all-time high to the bottom is 338 days, or around 11 months, which means that probably this drawdown could last all the way till 2023. Now, of course, I'm not saying that the market could go down by negative 30% or it will last for 11 months. That's not how averages work. It's like saying between me and Elon Musk, we own an average of 80 million Tesla shares each. Instead, what I'm saying is, if a bear market does indeed happen, we could expect it to go down by another 10% plus minus and easily last for around 11 months plus minus. This current downturn is caused by real issues that I mentioned just now, like inflation, interest rate hike, slowing demand, recession fears, and so on. So until we start seeing some of these issues going away, people will still stay on the sidelines and the market can go down even more. But is there any chance that I will be wrong? Absolutely. Anything can happen out of nowhere. Like in 2020, when everyone thinks that the market will dip even more, all of a sudden, the Fed announced that they are activating their money printing cheat code and cancelled the apocalypse. If we go to the root cause of this current downturn, it's caused by the Russia-Ukraine war. So thank you, Putin. Right now, everyone is expecting the war to continue on because both sides are not giving up. But if tomorrow Putin suddenly stops the war, the market will immediately go back up to the moon. So how am I investing now, knowing that the market can continue to go down, while at the same time, the market can suddenly shoot back up? The answer is actually quite boring. Dollar cost average. But let me show you something interesting. There's a guy called Nobjobs in Reddit. There's a post where he analyzed the past 3 market crashes. He used 3 different strategies. Hold, where he stops investing until the market starts to recover. Stays, where he continues investing as usual. And doubles, where he doubles the amount that he's investing. What he found was that if you had tried to time the market and time it wrongly, you will get the lowest returns. But if you had doubled your investments during market crashes, you will end up with the highest return. So that's what I've been doing, doubling down. I've been investing consistently since the crash started. Nothing has changed. Besides that, I'm also doing something extra. As all of you know, Tesla is a huge part of my portfolio, about 86% now. And all the rest are disruptive stocks like Square, Arcade, ArcG. They are called disruptive stocks because they disrupt my portfolio. Right now, I'm slowly selling off those disruptive stocks because I think that they won't do well in this environment. Only disruptive stocks I'm not selling my Tesla stocks. They are my precious. Meanwhile, I've also started buying safer stuff like Apple, Microsoft, Google. My goal is to make my portfolio safer by diversifying into other high growth stocks. Because while I'm still bullish about Tesla, that's a reason why no one all into a stock. Even chicken genius don't do that. One black swan event can easily KO Tesla, and I certainly don't want my portfolio to go to zero because of that. So I'll be lowering my Tesla percentage by adding on other stocks. As for you, yes you, I know that market crashes are scary, and it's painful seeing losses day after day. But there's a saying, riches are made in recessions. The best time to invest is when everyone is scared. So you need to do opposite of what everyone is doing and continue to buy the dip. Eventually, when all this is over, you will what big. Anyway, that's all for today. But what do you think? Are we at the market bottom yet? Do let me know down below. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.